We want to let you be aware that we do have some summer camps, online summer camps that are coming up beginning June 23rd through July 1st. July 3rd, I'm sorry, we're going to have our first camp on financial literacy and investing, which today we're going to talk about investing goals. All right. But if you have a student or you know of a student who would like to know more about financial literacy and how to invest, we encourage you to invite them to our online summer camp. We start at the age of 12 years old. Then we also have a second investing and financial literacy camp July 7th through July 18th. The camp is 10 a.m. to 3:30 p.m. with a 1 hour lunch break. So between 12 and 1, they have lunch. So they'll go 10 to 12 and then come back on from 1 to 3:30. The afternoon is interactive engagement, and the course material is taught in the morning from 10 to 12. We also have an intro to cryptocurrency and digital platforms beginning July 20th through July 24th. That's also 10 a.m. to 3 o'clock p.m. daily. And what you can expect for our course outline is for the financial literacy, they will learn basic banking, credit and debit, building a budget, business cycles, and understand economic policies, because that goes with investing. We have to know what is going on in our economy and how that is going to affect us being able to purchase goods and services and invest in tool instruments, which we'll learn some about today. We learn about the basics of an investment club and how you can form an investment club within your family or with your friends, because we can do more as a community than we can do independently. And then we're going to talk about what it takes to get started with that investment club. We'll talk about understanding how to build a brand. Okay. What is a brand? The brand is you. You are the brand. Okay. How do you build that brand? We're going to learn about fundamentals of stocks, stock analysis, then other investing instruments that you will need, which are bonds, mutual funds, ETF, and just all about how you put that together to build your portfolio is what we're going to be sharing this summer. And we would like to invite you to join us, or if you know of someone that may want to join our platform, we welcome them. And at this time, I'm going to have Mr. Kamari come on, and Kamari is going to introduce our speaker for today, who is going to be sharing with us and who has been around with us for the last at least 3 years, right, Alvin? I would say at least 3 years. Alvin has come and he has paid himself forward by coming back time after time again to share the information with our students, with our families, so that we can make informed decisions to help us to be successful on our investment journeys. So at this time, help me clap it up for Mr. Kamari, Junior Wall Streeter Chisholm, as he introduces our guest for today. Thank you so much.
Thank you. Mr. Alvin is an experienced financial consultant and has focused his practicing on assisting individuals, professionals, and business owners achieve their financial goals. Along with his team, Alvin has specializes in wealth management and asset protection. He has attended the University of Pennsylvania Warren Business School, where he focused on retirement planning. Alvin was also a student athlete at the University of Virginia's College at Wise, where he earned a degree in economics with an international business minor while playing on the football team. Alvin's goal is to help as many people as possible in the pursuit to uncover and secure their financial freedom. With his main office located in New York and satellite offices throughout the country, Alvin is able to provide his clients with high quality, concierge service while building relationships that last a lifetime. Outside of work, Alvin is very family oriented and loves spending time with those closest to him. His upbringing provides him with a selfless mindset to help those around him get where they desire to go.
Couldn't have said it better myself. Thank you. Appreciate it, Kamari. So yeah, I just wanted to say thank you to everybody taking some time out of their Saturday afternoon to spend some time talking about finances and what's going on in the market. So the theme of today is how to reach financial goals despite uncertainty. So I figured, just to keep it simple, I'm gonna kind of just break it up into three sections. First, why are we even having uncertainty in the first place? So I'm gonna give everyone like a nice quick, market update on what's happening in the economy and the financial markets. And then from there, we'll go into, how some things we can do just to kind of weather the storm financially. Um, Not sure who's actually on the call, so I don't know if I like to always make this, a little interactive. So I'm not sure if it's younger people on the call, older people on the call, people who are closer to retirement, but I'm gonna try to touch on, people in different stages of life today. But if there's anything specific that anyone wants to talk about, this is very interactive, so please, feel welcome to unmute and ask me whatever questions are on your mind. So, again, just to get started, I figured I'd just give everyone a nice, quick market update on what's happening in the economy. Um, can I share my screen or no? Say no.
No, you can share your screen. I'm gonna have it so you can share your screen. There you go.
Okay. Thank you.
And we have a mixed age group today, Alvin. We have college students, people close to retirement, and people who are just starting their adult journeys.
Excellent. So, let me share my screen. All right. Can everybody see that? Try to make this. All right. Thank you. All right, so what's happening in the economy, right? So, ironically enough, we actually had a really good week in the market this week, funny enough. But overall, the market has been down a lot this year. Why has the market been down? I'm sure everyone who's been turning on the news have been hearing, a lot about tariffs, right? Tariffs actually came into effect back on April 2nd. But I guess, just to kind of go on based on the timeline, this is what I'm showing right now. This is just the S&P 500, largest 500 companies in the US. And basically, we've actually had a really good year last year. For those who aren't familiar, market was up 25% last year. The year before was up just about 23%. So the market has been trending upwards. 2022, we had not so good year. 2022 was actually an anomaly where both stocks and bonds were down. About 19% the stock market was down in 2022. But again, we've been trending upwards. Again, the stock market goes like a little bit of a roller coaster, but it does trend upwards over time. But starting this year, the market's actually started to trend downwards more significantly. And the reason primarily was because of, like I mentioned, tariffs. But what are tariffs? For those who aren't aware, tariffs are basically whoever the country is that is enacting the tariffs. In this case, the U.S. is basically taxing people who are other countries who are importing goods to the U.S., right? And there's a global trade market for those who aren't aware. If you go around your house right now and you look at the label on a lot of things, it'll say made in China, made in Taiwan, made in this place, made in that place, right? So things, goods, services get bought and sold and traded all globally between countries all the time. So this year, the new administration enacted tariffs, or started talking about tariffs at the start of the year. And basically, tariffs, again, is a tax for any goods that are imported to the US. And the reason why this has been causing a lot of volatility in the economy and in the markets is because really two things. Tariffs historically always lead to inflation, right? And for those who aren't aware, we've been trying for the last 18 months to reduce inflation because of high interest rates, or the Federal Reserve raised interest rates over the last few years. And they actually started to cut interest rates toward the end of last year because inflation was actually getting under control. And those zoom things in the way. So just to give you a quick visual of what that looks like. So this is a quick little chart about inflation. So back in 2022, if anyone remembers, summer 2022, inflation was up to like 9%. Everything was going through the roof. Eggs, everyone's complaining about everything back in summer of 2022 because everything was expensive. Since then, the Fed, raised interest rates. And what raising interest rates does is it does basically just make everything more expensive. It makes borrowing, money, loans. That's why, to buy a house right now, it's still relatively high from an interest rate standpoint. So right now we're still in a relatively high interest rate environment, but the Federal Reserve has been cutting in, or while the interest rates were high, it was working because when interest rates are high, basically it encourages people to save. That's why all these high yield savings accounts and CDs are giving you 4%, 5% last year, trending downwards a little bit though this year. Um, and it discourages people from spending. So loans, mortgages, all this stuff have high interest rates in a high interest rate environment. So it discourages people from spending money. So again, the last, year and a half, because of the high interest rates, inflation slowly but surely started to trend downward. And even, for March, I think it was 2.7, 2.8. So having these high interest rates worked, right? Inflation slowly but surely started to come down. However, it's still a little sticky in some areas. Car insurance is getting a little bit better, but car insurance, some areas of the market, houses, it's still relatively inflated, but as a whole, inflation has come down a little bit. So going back to tariffs, the reason why, tariffs started to shake up the economy a little bit is because again, tariffs usually does lead to inflation. So again, that's, having inflation is not a good thing on the economy. It's not a good thing on consumers. So with that uncertainty of, hey, if tariffs come back into the picture, will inflation, start to creep its head up again? So that's number one. And then number two, tariffs also can slow down the economy. So because it's now more expensive to buy and sell between countries, understandably, countries may either start to buy and sell less, or transact less. You may start to see like retaliatory tariffs, like we saw a little bit a couple weeks ago, where the other countries are now taxing, U.S. to, import goods to their country. And then just from a company level, companies now, because they're charged more to, distribute their goods to different countries, they may start to just raise their prices, right? Because these companies still have to make money. So they may not just have to, they may start to raise their prices, and that naturally trickles down to us, the consumer, which goes back to the whole inflation conversation can come back again. But it does slow down the economy also. Tariffs have the potential to do that. So with all that being said, that's why you may have heard like the R word being thrown around, recession, over the past couple of weeks. But so yeah, those are the two kind of big things that tariffs can lead to. So long story short, the market was doing pretty well to start the year. We were up like 4%, middle of February, and then the talks of tariffs happened. Then the market started to trend downward. We lost like 10% in about 2 weeks, or in about 3 to 4 weeks. Then it tapered out, and then again on April 2nd officially, tariffs went into effect, and then we went down like 12% in a week. Then what happened, just again as a market update, about 2 weeks, 3 weeks ago, the administration came out and said they're going to do a 90-day pause on tariffs. So everyone's basically has like a 10% tariff, except for China. That's when the market kind of spiked back up. So right now, long story short, those are the two reasons why the market has been very volatile, is because the market doesn't like uncertainty. And because a lot of how tariffs will big picture affect the economy is still to be determined. That's why it's very, there's a lot of volatility at the moment. And to be frank, we just need time, to be honest with you. It's going to take a little bit of time to see how tariffs will affect the economy, because right now every country is pretty much negotiating to see what their individual trade deals will look like. But yeah, until like the hard data comes out to say, hey, is inflation actually increasing? Is the economy actually slowing down? Which will take obviously a few weeks or a few months to actually be able to compile that data. We just have to wait and see. And again, because the market doesn't like uncertainty, that's why we've been seeing a lot of volatility so far this year. So that was just a quick market update, just to give everyone a quick overview if you're not too familiar. I'm happy to answer any quick questions about the economy if anyone wants to unmute, but that's just a quick market update on what's been happening. Like I mentioned, this past week, ironically, this was actually a really good week in the market. The market's was up 7% this week since Monday. So we actually bounced back a little bit this week. So again, that's what volatility is. It's either volatility for the better or volatility for the worse. We just don't know where necessarily the market is trending at the moment, because of the uncertainty. But any quick questions? Does that all make sense as far as what's happening today?
I have a quick question.
Yep.
Um, so Trump doesn't like the current Fed chair. Does he have the power to fire that person from that position?
So I'm not a politician, but so to answer your question, I don't think he does, to be honest with you, but don't quote me on that. I don't think the president actually has the ability to fire the Fed chair. I think that's a Congress decision. I think the Congress actually appoints. Well, I think Congress actually votes on who the Fed chair or has a say in that, but don't quote me on that. I'm not too sure.
Thank you.
I can Google it though. That's a quick Google search away to find out that answer though. But I know that that's a fair question because I know people are, that's just honestly one of the, unfortunately, politics can trickle into the market, um, or can trickle into, economics. But the fact of the matter is the economy is either good or bad, to be completely honest with you. And then what goes into making sure the economy is good is if we have jobs, right? There's like unemployment is low. If obviously, the economy as a whole is growing, GDP is, actually increasing, the government, the economy is actually expanding. Um, you know, Obviously the stock market hopefully is doing well. So there's like economic factors. Inflation is low, ideally. There's like economic factors that show how well the economy is actually doing, regardless of who's president, right? The president's job is really just to make sure if things are going well, guess what? Let's keep the train going. And like, for example, when there was a recession back in 2008, the administration's job is to just fix the issues, right? How do we, enact different laws? How do we pass different things to right the ship, right? So last year, like I mentioned, the markets has been doing well. Uh, you know, just to give you a visual as I'm talking, the page 18. This is GDP. This is GDP, give or take, is like 3% on average, historically. You kind of want to have the economy growing by at least 3% or so each year. So if possible. Um, but yeah, the economy was actually doing well, relatively, over the past few years. And again, nothing's just because tariffs are now enacted, that's not going to say the economy just overnight is going to be doing bad. It will take time to see how it's going to affect things. But yeah, as far as like if the Fed chair gets fired or something, that's not really going to be a huge factor in things. A lot of the things you see on the news, unfortunately, is a lot of noise. You kind of have to filter out some of the things you hear. A great, fair question, though.
Josiah, you want to ask your question? I see your hand is up.
Yeah. I just had a question. I mean, as you know, the stock market is definitely, particularly more volatile than what we're traditionally used to, as well as bonds.
Mhm.
Bond market as well is surprisingly volatile as well due to a lot of things that's happening politically and international affairs and so forth. What are you seeing right now, where people are kind of like placing their money in the midst of
Yep.
all the volatility to kind of like just hedge and be able to have some sort of
Yep.
reliability?
Yeah, I'm gonna answer that question, Josiah. Thank you for the question. I'm gonna answer that question in like 10 minutes. I
Okay.
just wanted to make sure because I just want to give first everyone a quick market update, then we'll get into like how to actually and better invest in times of uncertainty. So good question though.
Also, one last question. I don't know if this is going to be
Yeah.
somewhere in the presentation, but just also like it seems like a lot of people who are able to take advantage of these opportunities because this is opportunity are people who are
Absolutely.
folks who are
Absolutely.
pretty well off, but like for everyday folks like myself, like how do
Yeah.
we position ourselves to be able to, be able to come out at least better than where we are right now?
Absolutely. Yeah. To be honest with you, wealth is made when the market is down. So when the markets are down, it's not time. Now, I'll get into, you know, the logic in a second, the principles in a second, but money is made when the market's down. The fundamental truth with investing is you want to buy when the market's down, you want to sell when the market's up. I will touch on something did just say is, you know, we've been on like a bull run literally the past, I mean, to be honest with you, since 2008.
Yeah,
Right?
yeah,
So it's kind of like, you know, people aren't used to the market going down. That's really what it is. Like we've been conditioned to like only see the market going up. So
yeah,
that whenever the market goes down, that's just what the market does. It goes up, it goes down, it goes up, it goes down. There's always going to be a correction. That's just natural with how the markets work. So yeah, we've been conditioned to just seeing the market go up for so long. It's like people aren't used to seeing the market go down, just realistically. And I'll get into like how we can hedge our investments in a second. I don't want to get off track, but just as far as, general market update, that's what's happening. Tariffs have happened. Still TBD. It's on a 90-day pause. Again, a lot of it's going to really materialize over the next few months. We do expect a lot of volatility, to be honest with you, over the rest of the year. Because of going back to the Fed question, because tariffs usually lead to inflation, and we probably expect inflation maybe to creep up a little bit. We don't expect the Fed to cut interest rates anytime soon. They're probably going to keep it where it is for the foreseeable future, especially if they see, inflation creep back up a little bit. Um, Going back to that Fed question, but again, that's what's happening in the economy. The volatility is literally coming from that one uh, action of tariffs. It's not coming, from anything else. That was the seed that really kind of made that rocked the boat, so to speak. I'll get into this in a second, but before even the talks of tariffs, like even though the markets have been doing well, the markets have been very concentrated, right? The reason why the market did amazing last year, to be honest with you, was mainly because of a handful of companies, right? There's something called the Magnificent Seven, the tech companies, NVIDIA, all these different big companies. Most of the growth that was happening in the market in the last, year and a half, 2 years, have really been coming from large growth companies. So even though the markets have been doing well, the markets have been very concentrated. And, you know, I'll get into this, as far as like showing you guys some visuals and the importance of diversification, but we were well overdue for a correction. Tariffs may have been the thing that kind of accelerated the correction, but the markets were very concentrated coming into this year. And again, we're probably overdue for a correction anyway. But that goes back to the importance of understanding how you're invested and making sure you're properly spreading out your risk by being diversified. Um, but yeah, save that question, Josiah. I'll answer that in like 5 minutes. Any other questions though, as far as like overall like market before I go move on?
I just wanted to know, could you explain to them just quickly what the GDP is? For some people who may not know what gross domestic product means.
So yeah, GDP, that's just again, you just said it, So it's gross domestic product, right? So that's basically how we calculate how much the economy is growing, like what percentage of growth the economy is growing by. And this is just a chart that shows like where the growth is coming from. And they always show it every quarter, by the way. So GDP is tracked quarter by quarter for those who aren't aware. So whether it's like, so the consumer, you and I, like us literally spending money, like you can see, is literally the majority of GDP. So you and I, the consumer, how much we actually consume, like buy and sell products and services, we make up the largest percentage of like GDP. So the consumer is literally the backbone of the economy, because unlike other, I mean, when I say economy, like the U.S. economy, because other countries, for example, the biggest part of where they get their growth from in their economy may be because they produce, rice or grain or oil or this or that. So other countries, how they grow their economy is different because they may be more of a, manufacturing economy. The US, we are literally a consumer economy. Like we literally buy stuff so much from like all these other countries. That's why we have so many imports into the US. Like we literally buy everything from all over the world. So we're a consumer economy. So how much we spend, how much we consume, that's a huge part of how much the economy. That's one of the biggest indicators of how well the economy is doing and how much growth we're seeing in the economy. But there's different factors that go into, GDP, government spending, residential, exports, blah, blah, blah. But all GDP is just the rate of growth of the economy. And they track it every quarter. Good question. Any other questions? All right. So yeah, that was just a quick market update. That's what's happening right now. Again, just fundamentals, how to reach financial goals despite uncertainty. So first things first, again, I'm a financial advisor, financial planner, if you will. What I do is literally help people put together financial plans. And what that means is, if everyone may or may not have had an experience in working with a financial advisor before, literally my job is to help whoever I'm speaking with get from point A to point B with their goals as efficiently as possible. Right. So if you say, hey, Alvin, I want to retire at a certain age. Hey, Alvin, I want to buy my first house in a couple of years. Hey, Alvin, I want to save for my kids to go to college. Hey, Alvin, I want to do this and that, or that. My job is to just help you quantify how to get there as efficiently as possible. So I say that to say, even if you're not working with a financial advisor or you are, the principle is we have to have a plan to reach our goals, right? So we have to have a clearly defined plan to get where we want to go. Like if you jump in a car, the first thing you do is you put in the address in the GPS. It tells you where to go, take a left, take a right, right? The same thing's true with your finances. You first have to have a plan before you're able to get there. So whether it's like retirement goals, investment goals, whatever, you want to make sure we have a clearly defined plan. And I was going to show you guys, a quick little cheat sheet of like, this is just one of our financial planning softwares. It's called Asset Map. There's a bunch that we use. There's a bunch that are out there. But again, I just want you guys to understand the principle of understanding, first where your moving parts are. Because a lot of top people I speak with at times, they're not really sure, what they have, right? They don't know how much is in it, that you may or may not be fully aware of like where your retirement accounts are, how much they're growing, how much debt you have, how much, what your cash flow looks like, money coming in, money going out, your insurance portfolio, how much do you need in retirements, right? First, you want to know where you are today, and that's the reason I'm showing this is just a quick, analysis of where somebody is today, for example. And then from there, what I do, as a financial planner is like projecting and doing analyses to see how on track we are to get to your financial goals, right? Because it's one thing to say, how do we get there, or we want to get here at a certain time, but realistically, are we on track to get there? What is there a gap in our plan? Is there some changes we have to make? That's really the value in first understanding where you are today and understanding what you have to do to reach your goals going forward. And again, this is just me exposing you to, what financial planning is. So for example, if somebody says, hey, I want to retire at a certain age, I'm able to run these analyses based on a certain rate of return, discounting inflation, and just seeing how on track we are to get to this goal, for example. Retirement, for example, just continuing that, we also stress test our, our projections. So let's say you have to go into a nursing home or something. When you're retired, how does that affect your picture? What happens if you get disabled, if you pass away, XYZ, right? So we're able to just see how on track we are to these different goals. So the reason I'm bringing this up is one way we can, reach our goals despite uncertainty is by being very clear on first what your goals are and fully understanding what we have to do to get there. And um revisiting. So plans, I would say plans are meant to change. So even if you say, we do plans all the time for people, and the initial plan 5 years from now, 3 years from now, even 2 years, 1 year from now, the plan can change, right? Things may happen in life. So the plan that we initially put together, we always want to make sure we revisit it, it gets updated, we make sure, things are still, we're just make sure we're always on the same page with our goals. But after you first understand what your plan is, you have to make sure your investments are lined up with your goals. Because the only way, or the most efficient way to reach our goals, is by investing, right? You can't retire when you want to by just putting money in a savings account for 30 years and then hoping you have enough 30 years from now, right? The eighth wonder of the world is compound interest, for those who aren't aware. Interest on top of interest. So by investing, it helps us make our money work harder for us, and it helps us reach these different goals a lot more efficiently over time. So again, making sure we have a plan, and then making sure our investments are lined up with that plan. And then and how we make sure our investments are lined up with that plan is by just first understanding your time horizon and your risk tolerance, right? So for example, time horizon, for those who aren't aware, let me I'm a drawer, so I'm gonna, hopefully this looks okay on the screen with all these words. Let me do this. There we go. So time horizon, there we go. So all time horizon is like how long between today and you actually reaching that goal. And then, so for example, if you have a longer time horizon or a longer runway, let's say somebody's 30 years old, he wants to retire at age 60, we have a long time between us putting money away, investing in it, for example, between today and us actually needing that money. Time horizon is very important because, for example, like, this year, the market's a little bit volatile, the market's down a little bit. For somebody who's, 20, 30, 40 years old, for in this specific example, for retirement, let's say, and they don't need the money that's invested, even though their account may be down 10%, whatever it is, we don't necessarily care, to be honest with you, because again, we have a long time horizon. So we can basically just continue to invest, ideally, reinvest when the market's down, and ideally when the market rebounds, we have enough of a runway to be able to ride the market back up over time. Now, somebody doesn't have a long time horizon, right? Going back to like 2008, for example, if you were on track to retire in 2008 or 2009, 2010, and your 401k went down 30%, that's a different story, understandably, right? Because we don't have enough of a runway to have the market rebound ideally, and you make you be able to kind of bounce back in your portfolios. So depending on your time horizon, that's going to help us understand how aggressively or not you should be invested. That's number one. And number two is understandably your risk tolerance, right? So your risk tolerance, all that is saying that, hey, how aggressive or conservative should we be? So just again, this is just me, just from an educational standpoint. When somebody says, hey, I'm an aggressive investor, hey, I'm a conservative investor, all that basically means is how much equity exposure you should have in your portfolio. So if somebody says, hey, I want to be a very aggressive investor, all that means is that the majority of their money should be invested in stocks, right? So whether it be like ETFs, mutual funds, but the idea is it should be invested in largely equities, if they're truly an aggressive investor. If someone's truly a conservative investor, all that means is the majority of their portfolio should be, in more safer instruments like bonds and fixed income solutions. If somebody's in the middle, so whether it's like, somebody in the middle, 60-40, XYZ, all these percentages, there's something called modern portfolio theory. So let's say somebody's aggressive, maybe they should be 90-10. 90% equities, 10% fixed income, or 90% equities, 90% stocks, 10% bonds, for example. If somebody's conservative, maybe 80% bonds, 20% equities. Somebody's more so moderate, maybe 60-40, right? These percentages don't just come up from thin air. There's something called modern portfolio theory and the efficient frontier. And long story short, this guy named Harry Markowitz won the Nobel Peace Prize for economics back, whatever, 50, 60 years ago. And basically he came up with this theory on how do we maximize our returns while while minimizing our risk. And these percentages basically equates to somebody who is moderate being able to have enough risk in their portfolio match up with how much returns it's actually yielding. So that's what the efficient frontier is basically lining up how much risk you're taking with the returns that you're expecting. And these percentages is ideally how you should be invested if you are a conservative, a moderate, an aggressive investor, for example. So going back to the reason why these match up, time horizon and risk tolerance, is if it's going back to the person who wants to retire in 3 years, for example, and they don't really have as long of a runway, understandably, because they don't have necessarily a long runway, they shouldn't really be that aggressively invested, right? Their portfolio should be ideally not necessarily 100% conservative, but not as aggressive per se as the person who has a longer runway, right? So I say that to say, the first way we, weather the storm, we can still reach our financial goals, despite uncertainty, is by first, again, having a plan, and again, making sure your investments are actually in line with your goals, right? Because sometimes I meet people all the time, I look at their portfolio and they say, hey, I'm a conservative investor, but their portfolio is like 80% stocks, right? So sometimes we aren't really fully aware of how exactly, we are invested. So we do, again, want to make sure we have a plan, but then we also make sure our investments are lined up with our actual goals and investment strategies. So I'll take a quick pause there. Hope that all made sense. But any questions with time horizon planning? Let me know if you have any questions. I can't really see anybody, by the way. Can't really look at the chat either. I don't know if
I got you. We don't have
Yeah.
any questions thus far. But guys, I just want to make a point. The younger you start, the better, guys. Time on your side, like, is golden. The younger you start, when he's talking about investments and risks, the longer you have to recover. Like he said, if you're 30 and then you got 30 years, you don't have to be as concerned as if you're 50 and you only got 10 more years. You have to be very strategic about how you're going to be investing your money, because if you're too aggressive, you don't have enough time to make your money back. You only will have that time if you start young. So I just want to encourage people who are in here in their 20s or 30s, start now, because you have time on your side. And as he shared, compound interest is the eighth wonder of the world.
Thank you, Ms. G. Appreciate that. So going back to Josiah's question, so how do we minimize the risk in our portfolio, right? So again, just first principally, it is diversification, right? Diversification, and for those who aren't aware with what diversification is, so again, even if you say, hey, I'm a, let me 1 second. There we go. So let's just take moderate, for example. So even if somebody says, hey, I'm a moderate investor, which means, again, ideally you should be, 60% in stocks, 40% in bonds. Again, ideally, you're not just going to get one stock or one ETF and then one bond, right? Because there's different areas of the stock market, there's different types of bonds. So that's where diversification comes in. So you could have, in that 60% of stocks, for example, you could have large stocks, you could have smaller stocks, mid-sized stocks, international stocks, right? And then so we can be very, very, there's like, we could be very super diversified, right? So again, taking the same 60-40, right? Moderate. There's large cap growth stocks, there's large cap value stocks, there's mid cap growth, mid cap value, there's emerging markets, which are like more, smaller, developing countries, there's more, developed international companies. There's REITs, which is like real estate on the stock market. There's commodities, gold, different things, alternatives. There's muni bonds, there's corporate bonds, there's government bonds, there's long-term bonds, short-term bonds. There's different types of, so you can really, really spread out your money into the multiple different areas of the market. And that's really fundamentally speaking, the first way you can reduce the risk in the market is by being diversified. So, again, just to drive home the point, this chart is just showing us, I kind of call it like the periodic table of investing. And all this, looks like a lot going on. All this basically is showing is since 2010, this is this first column, this first row up here is the best performing asset in each year going back to 2010. So this top row, that's the best performing asset. This bottom row down here, this is technically the worst, this was the worst performing asset in each year going back to 2010. So basically the reason I'm showing you this is that there's no real consistency in this picture. The only real consistency in this picture is this white box, which is, basically a diversified portfolio. So a diversified portfolio, like you see the white basically stays relatively consistent, right in the middle. It's not going to be the best each year, but it won't be the worst each year. So having each of these other boxes in your portfolio, large companies, international bonds, this, that, and the third, you basically can spread out your risk because there's not always going to be the same winner each and every year, you know, historically speaking. Now the funny part is I show people this picture and they basically say, hey, Alvin, this light green, which is large cap, it's relatively toward the top, right? The last decade. And that was what I was saying, back earlier with how the market was very concentrated. So funny thing is like if you actually were diversified or diversification technically actually hurt you over the last handful of years because again the market was very concentrated over the last couple years. Again, most of the growth was coming from these large growth companies, right? US large growth companies. So because it was concentrated, you had everyone just like funneling money, and obviously they were doing great. The earnings were good in a lot of these big companies, but again, the market was still very concentrated. So I jokingly say that this that large. So I say that to say people got going back to Josiah's question. People got used to getting this amount of growth, right? People got used to not being diversified and still making money in the stock market, which that's not really fundamentally how you should be invested. People got used to taking on maybe a little bit too much risk than they probably should have been taking in their portfolio, so that when something happens, stuff hits the fan with tariffs and uncertainty, and now the market's a little bit more volatile. Now we see maybe you may see that your portfolio may have been a little bit too aggressive or a little bit too concentrated, then maybe you maybe see your accounts going down a little bit more than you'd like it to. So I say that to say, the fundamental way to reduce your risk in the volatile markets is diversification. Not having all your eggs in one basket, and it will help you weather the storms, no matter what happens historically over time. So I say that to say also, like, not if we had this conversation, if we had this talk last Saturday, because again this week, funny enough, the market, some of these stocks actually did pretty good, but even so, a lot of these large companies are still down relatively this year. So Nvidia is down 20%, and Tesla's down, even though Tesla was up a lot this week, but Tesla's still down 25% year to date. A lot of these big companies, Microsoft, you go down the list, all these companies that all had 20, 30, 40, Nvidia was up like 170% last year. They're all down like 20+% year to date. But again, going back to Josiah's question again, now is actually still a good time to potentially buy in. Hypothetically, no, not here to give advice, so I don't get sued. But when markets are down, it is actually, not a bad time to put money into the market. Because again, you're buying, good companies. Ideally, do your homework, do your homework on the company if you want to invest in stocks, or if you just want to track an index, you know, some of these indexes are down, no, not as much anymore, but it was down like 20% almost, the S&P about 2, 3 weeks ago. So it's not a bad time to, invest in some of these companies, or per se, if you have extra money on hand. But I say that to say, again, diversification is a great way to minimize your risk in the market. Now, even though, but what to invest in, right? International was actually doing really well this year so far, like developed international as a hedge, like compared to the US market, GS index. So it's like an international fund that tries like growth international companies. So even though the US is down, the S&P 500 is down, whatever it was, 5%, 10%. International markets have actually been positive so far this year. So that's actually been a good hedge, in the market. Bonds also too. Bonds are actually, maybe different types of bonds, but bonds have actually served as a pretty good hedge as well so far. Bonds are relatively consistent, other than in 2022 when both the stock market and the bond market was down. But obviously, that's always a, not a bad hedge. Gold has been pretty good, some commodities. But again, the point of it is you want to understand how you can diversify to minimize your risk, because ideally, each of these areas of the market, they don't move in the same direction. When some part of the market's up, other parts of the markets may be down. So the idea is basically, and like this picture shows, with one area being up, other areas being down, it ends up reducing your risk and gives you more consistent returns over time. And ideally, if you are contributing or reinvesting along the way, that also helps with just helping out with your returns and minimizing your risk as well, because you're doing something called dollar cost averaging, if you are contributing along the way relatively consistently. So diversification is one of the fundamental ways to reduce your risk. And, like I mentioned, there are some specific areas of the market that have actually been doing better than others so far this year. So I'll pause right there. Any questions? Hope that all made sense. And I apologize because I literally can't see anybody. I can only see
No
my
questions so
screen.
far.
Yeah.
We don't have any questions in the chat. And that's another thing, guys. If you want to have a question, you don't want to unmute yourself, please put your questions in the chat. I'll be glad to read them for you.
Right.
And also, I'm going to put Mr. Alvin's information in the chat. If you would like to make an appointment for financial consulting, I'm going to put his appointment calendar in the chat so that you can make an appointment, because you can always have more than one account. So if you work a full-time job, you're already investing in the stock market, do your retirement plan, someone's just doing it for you. And what they usually ask you when you're employed is, what type of investor are you? They want to know about your risk, as he shared with us. If you're a low risk investor, then they're going to have your portfolio and things that don't have much risk, like your bonds, your CDs. You know exactly what you're going to get on your return on those investments because they tell you going in. However, stocks, mutual funds are a little bit higher risk. Stocks are the highest. You don't know. It's going to depend on the market. It's going to depend on what is going on in our economy. And he shared with you about inflation. He shared with you about the tariffs. These are types of things that impact our economy that is going to impact the stocks, which is going to impact your gains and losses. Okay. But again, if you are a moderate investor, okay, this is building your portfolio, then you want to have a little bit of all three of those things. And that's where he talked about diversification. Diversifying your account where you have some high risk, some guaranteed low risk investments, and then like your mutual funds would be like your moderate risk investing. That's where you're pulling your money together with other people's money to purchase those investments. Because if I only have $100 and I want to invest in something, but I see TJ's on here, Angela's on here, and D, if they have $100, we can pool our money together, and that investment manager will take our money and they will pull our money together to purchase things for us, that so we can all make money.
Excellent. And I had to look that up, the Fed, whoever asked me the Fed question earlier. So neither the president nor Congress can dismiss a Fed chairman before the term is over. So he
That
can't
was
get
your
fired.
question, Elena. Did you hear the answer? That was Elena's question.
Yeah. So, but the president does appoint the Fed chair though. So whenever his term is over, basically, then the president does have the ability to appoint the next person. So, but he can't fire him, basically. To answer your question. All right, so diversification, that's one way we minimize risk. I was going to share just one other quick strategy for people who may or may not be aware that this exists or not. But there's something called structured products. So there's many different, so diversification is one way to hedge your risk in the market. Another way is a few different ways, but just for the sake of time, another way that you can actually hedge your investments is what's called structured products. There's things called structured notes. There's a bunch of different types of structured products, but the gist of it is the returns of this solution is tied to an index. So it's tied to like the S&P 500, for example. So whatever the S&P 500 does, that's what your account's going to do, like the picture we saw a second ago. However, the structured nature of it is basically they give you what's called a level of downside protection. So whether there's a bunch, I don't want to get into the details because there's a lot of different types of structured products, but just know it can either be like a hard buffer or a hard floor. So if you lose money, basically there's no loss whatsoever, or it could be like a buffer. So for example, this one's like a buffer that I'm showing you. So this has like a minus 20% buffer. So what that means is, like you see in these last two columns, if the S&P 500 goes down, let's say 15%, because you have a minus 20% buffer, guess what? You don't actually lose anything. So whatever amount of money you have in that investments, for example, 100,000, after the time frame is over, there's usually like a duration over a few years. And it matures, so to speak. Guess what? Your investment is returned to you. So instead of being down a certain percentage, guess what? You don't lose anything. All of your losses would be absorbed and you get your $100,000 back, for example. If the market goes down a little bit more than the buffer, let's say the S&P goes down minus 22%, and you only have a minus 20% buffer, again, 20% of it will be absorbed, and you end up only losing, 2%. So your 100,000 turns into 98,000. When everybody else is down 22%, your account's only down 2%, for example. So how these solutions work, I just wanted to bring it to just for additional education for people who aren't aware of what's out there in the marketplace. There are these structured products. There's a bunch of different ones. Don't have time to really go into individual differences, but the gist of it is you basically have the ability to track a major index, whether it's the S&P, the NASDAQ, whatever the case may be. If the index goes up, congratulations, you made money. And they use usually some sort of cap, just so you know, that's what this top line is. So hypothetically, the index goes up more than the cap, you would get only whatever the cap is, right? So if it's a 90% cap, your 100,000 turns into 190,000 over, in this example, it's a 6-year period. So you're able to appreciate with the markets on the upside. But again, the reason I'm sharing this with you to answer the question is the theme of today is how do we hedge our investments? What are out there to kind of weather the storm to still reach our goals? Some of these structured strategies may be applicable to kind of, minimize the risk a little bit whether the equity side of your portfolio that's a little bit volatile at the moment. Because the fact of the matter is, whether people realize this or not, retirement is a long time. So you're never, ideally, you're never going to completely exit the market, right? Even after you retire, let's say you retire at 65 years old, for example, and then you live until 95 years old, God willing. That's 30 years of still spending money, still needing money. And obviously, if you're retired, you may still do something and to earn some income potentially, but you're not going to be earning as much potentially as you were when you were working. So whatever money you still have built up in these 401ks and all these assets you've ideally built up before you retired, you're gonna still need some of that money invested so that, you know, understandably, inflation, historically, by the way, inflation is about 3% a year. So if your money's not growing by at least 3% year over year, you're technically losing money, you're technically losing purchasing power. So we always need to have money invested even after you're retired. So, but doing so prudently, doing so in a way that can, not take on too much risk. Again, this is just me sharing another thing that's out there that we may or may not be aware of. But there's something out there called structured products. And yeah, the gist of it is it is a way of hedging your downside on a portion of your investments. And yeah, I'm not going to get into it too much, but it's basically similar to like options. So like options basically is a way of also hedging the downside on your individual stocks potentially. Um, but yeah, there's a few different ways to hedge, but the idea is understanding how much risk you're taking in your portfolio, going back to the aggressive, moderate, conservative, and making sure that actually lines up with who you are as an investor. And if it's not, you either want to, change up your allocation, be diversified, or maybe layer in different strategies that can, you know, also add different hedges, like a structured product, for example. So that's one quick strategy that you may or may not have been aware of. Let me know if you have any questions with this.
Okay, I have a question.
Mhm.
Hi, I'm Angela.
Angela.
Yeah, thank you for the information.
Mhm.
The question I have is like with your firm,
Mhm.
like with all everything going on. So did you reached out to your clients to give them advice, or you waited till? I mean, do you tell them like, oh, you should move your money such and such a place, or you let them tell you, come to you with the concern? How do you work that?
Good question. So we're very proactive.
Okay.
So when you're working with a financial advisor, my job is like we talk. We want to make sure we're on the same page. So the foundation, what I do is literally financial planning, right? So that's the first step of the puzzle, like understanding, clearly defining your goals, clearly defining, what the objective is. And then if we do end up investing to kind of help us make sure we're on track to these goals, we're periodically meeting with our clients, whether it's quarterly, whether it's every other month, whether it's semi-annually. Now we're always, staying in contact. And sometimes, for example, like things like this, we may, you know, have impromptu meetings to answer your question, right? So we may talk a little bit more often, potentially. If things are a little bit shaky, but to answer your question, we're always in touch with our clients. We're doing periodic review meetings to make sure that, we're understanding how your account's performing, how the overall market is performing, what's the outlook going forward, and we're letting them know what adjustments need to be made in the portfolio to answer your question. Um, you know, Based on our research, based on our investment philosophy, we're gonna tell them who or educate them on how we think we should be changing our investments to minimize the risk a little bit. Like for example, one thing we did this year is we actually increased our international um, positions, right? Just like I showed a second ago. Because again, international has been doing a little bit better than domestically so far this year. So there are different adjustments we make, and we always educate on what's happening and why we're going to make these adjustments if possible. But it's a two-way street. It's not just like telling kind of demand, because understandably it is your money. So, definitely it's also up to you too. We're definitely going to educate you on, what we think. But there are times, you may just say, hey, Alvin, I got some clients right now that, because the markets are down, they ask me their opinion on they ask me my opinion on, certain individual stocks that they may be interested in investing in. And they may tell me that, hey, I want to invest into this thing or this stock or this or whatever. So it's a two-way street. But from our perspective, we are very proactive. We check in periodically to make sure we're always on the same page and reviewing the accounts going forward. Good question, no?
Thank you. I had one other question, one more question. When you just
Yep.
was speaking about, like, if you retired 65 and you may live to 95. So, most people, at least maybe I had this thinking, when you retired, like, what's in your retirement account is what you're gonna be living off of. Like, you'll get something per month. But in essence, what you're saying, we still should continue to invest even though we're retired. Is that what you said?
Yeah. So
Okay.
and I'll elaborate. Excuse me. So so simply put, when we retire, so we have what do we have? We have 401ks, which is I guess the primary, retirement account for people. 401k, 403b, deferred comp, all that stuff. It's all the same thing, basically. It's a bucket you throw money into and it gets invested over time, right? And then we're kind of earmarking it for retirement down the road. Um, so beyond the 401k, so to answer your question, during our working years, we're making income and we're putting money away to the 401k, right? And that 401k is being invested and growing over time. In retirements, we're not going to be making too much money, right? Because where is our income coming from in retirement? We may have Social Security, right? We may have Social Security coming in if you're lucky enough to have a pension, right? That's a big thing. You may have some rental, real estate, rental properties potentially. So these are some ways you may have an annuity. Annuities can pay guaranteed income. So then maybe you may have different things to like generate income for you in retirement because you yourself aren't making as much as you used to when you were working. The other place you can get income from is, yes, your 401k, right? Now, when you retire, it's not like you just liquidate your entire 401k and just like tell them to send you a check and deplete the entire thing. That's not what happens. What happens is, I mean, you can do that to be fair, but that's not the wisest thing to do. But yeah, what normally happens is you basically either take money out periodically, like whether it's yearly, whether it's quarterly. If we're actually actively managing, so what you'd normally do, just to provide some context, what most people do after you retire, so you first roll it over into an IRA, which is an individual retirement account where you have a little bit more control and it's not something set up through your company. So that's technically the first step. But from there, like I mentioned, you either take income from it or you know, or or you just leave it and allow it to continue to be invested. But regardless of the case, whether the portfolio itself is, growing or invested in a way that it's going to be producing income for you, or you yourself are just taking withdrawals every so often, the idea is to, yes, take money out from that nest egg that you've been building up for who knows how many years, but you're not going to get depleted in one shot. You're going to be just taking money out periodically, potentially. But the balance of it, it's still going to be invested. So the balance that's still in the account is still going to be invested and ideally growing over time, even though you are taking some money out or potentially using it for income. So you're never going to deplete or take this money out completely, that money is still going to be invested in some way, shape, or form inside of the IRA. Again, at that point, because you need the money, you're definitely not going to be aggressively invested. So you're probably going to be more in like bonds, like we mentioned before. So you're probably going to be more of a conservative investor at that point, potentially, or maybe somewhere in this range. So even though it's still invested, ideally it's not going to be fluctuating too crazy, because you're not going to be too exposed to stocks. So yeah, it's still going to be invested, is what I was getting at.
Okay.
Because if it's not invested, then again, that word inflation, everything over the 30 years of being retired, the eggs, the food, the gas, the clothes, all these things you're going to be spending money on is going to be increasing in price over time. So again, we have to make sure your money is still growing by at least a modest percentage, to kind of offset that effect of inflation. So that's what happens when you retire.
Okay. Thank you. Thank you. This information has been very helpful.
No problem.
Thank you.
Question. Any other questions? And going back to that retirement question, one of the big things we do from a retirement planning perspective is you have to first understand how much income you need in retirement, right? Because if right now you're making whatever 150,000 a year, you got a mortgage, you got this, you got that, you got this, you got that from an expense standpoint. If you project, in retirement, you need 5,000 a month in retirement, right? That's 60,000 a year. Where is that 60,000 a year going to come from, right? We may do a calculation. You go on SSA.gov to see how much you're going to be getting Social Security. Social Security may be giving you whatever, let's say 3,000 a month, right? So now we got 2,000 a month left over that you need to just cover just to live in retirement. Where is that going to come from, right? It may come from your 401k. Do you have a pension? Do you have this? Do you have that? Do you want to sell your house and downsize, and that'll give you a nice chunk of money potentially to help out with just cash on hand and paying off expenses. So retirement, it's a very involved conversation, and that's the value of having a financial planner, someone in your corner, to kind of help you understand the variables. One of the biggest expenses in retirement is health expenses. So something called long-term care. I'm not sure if anyone has long-term care insurance or knows what that is, but if you ever have to go into a nursing home or something like that, it's like living in New York, it's like 17,000 a month to go into a nursing home. So understanding like how all the different variables in retirement and different risks you have to plan for, that's the value of having, a financial advisor, and kind of making sure you're checking off all these boxes and stress testing your how on track we are to getting to these goals.
Okay, we have another question. If
Mhm.
if Social Security is gone in 30 years, how will people
Mhm.
manage?
Great question. So for our younger clients, to be honest with you, we're not even like planning to have. So I guess to finish my statement, I say for my younger clients, we're not even like planning that Social Security is going to be there. But to provide some context, there's a good chance, it probably will be there, to be honest with you. And the reason I say that is like even though, technically the Social Security is on track to be depleted in 2035 or whatever they say, there's always going to be something that the government does to kind of put a Band-Aid on it to just keep it going, ideally, right? So whether they're going to increase the full retirement age, before it was like 65, now it's 67, they may, in a couple of years change it to 69 or something. They're going to put these little Band-Aids on it to just hopefully keep it going for as long as possible. But ideally what they really need to do to keep it going is they need to raise taxes, Social Security taxes, to keep it going. But again, I'm not a politician. That's not a friend. That's not an easy topic to have to say, hey, I'm going to raise taxes. Nobody wants to pay more taxes. But yeah, so that's why, we'll see. It's out of my control, obviously. So, but for our younger clients, we're not even expecting it to be there. But just from a history standpoint, there was something called the three-legged stool from my older folks on the call. It's not the best stool, but there was something called a three-legged stool. And basically what this was from like a retirement standpoint, it meant that basically you're going to have Social Security in retirements, you're going to have your pension, and you're going to have 401k, right? So that was kind of the three-legged stool. Those are like the three things that you would help you in retirement years. Long story short, there's not, unless you're a firefighter, cop, state employee, government employee, that's the only reason you have a pension. If you're not, you don't have a pension. So this leg of the stool is basically no longer here for most people. Like we just said, Social Security, we'll see TBD if it's going to be here, but that's kind of it's kind of standing on its last leg. But the government slowly but surely, and companies slowly but surely also having kind of shifting the responsibility of retirement to you and I, the consumer, the individual person. So a lot of weight is passed on to you personally to save for retirement, right? So that's why, so literally the 401k is like the biggest, unless you're doing like other things, just like, by yourself, investing in a business, or some people, their business is their retirement, right? They're going to sell their business and hopefully it'll be enough to, make them have enough in retirement. Some people are doing real estate to kind of supplement things potentially. But from like this three-legged stool, which is what it was back in the day for all of my older folks can to attest to that, the government has basically slowly but surely shifted the responsibility of retirement investing to the individual person. So that's why the 401k is kind of the only thing that most people have potentially earmarked for retirement. Why it's very, very important to invest, whether it's a 401k, an IRA, Roth IRA, because again, if you have a lot of time on your side, so my people who are 20, 30, 40 something years old, because you have, 20, 30, 40 years until retirements, you have a lot of time to really appreciate and just kind of ride the roller coaster and, have ideally a good amount of money in that 401k, in that IRA, before you retire. But that's going to be a good chunk of what your retirement picture looks like when it's all said and done, is whatever's in that account. So, so I hope that answers the question about Social Security. But yeah, that's really all I have for you everyone today. Hope that was helpful. Hope that was educational. And just wanted to touch on a couple concepts, couple topics. And hope that was valuable. But yeah, if any other questions, I think Ms. G is going to share my information. You can always contact me one-on-one. Again, I'm here as a resource, and I always love coming back to, Black Wall Street is great, great cause, great people. So, knowledge is power. So keep tapping into Black Wall Streeters, and they're doing a lot of really good things. And again, I'm always happy to come back and share some wisdom. Thank you.
Thank you so much, Alvin. Y'all clap it up for him. Give him a round of applause. We appreciate you as well, and we value the partnership and networking relationship that we have built. I wanted to make sure that everyone had access to the chat to be able to see the information that I shared with you in the chat. Did you guys see that? Yes or no? Give me a thumbs up, or just give me your voice to let me know if you did receive that information with his calendar information. Yes. Okay. Awesome. I got one. Yes. Okay, thank you. And guys, you know what we have to do? We have to support one another. So if you already have a portfolio manager, but you know other people who don't, pass on, pay forward, and let's help each one another, to continue to build, especially in these unconvenient times right now, right? Because we never know what's going to happen right now, but we want to be planning. If you have a plan, and like he shared with compound interest being the eighth wonder of the world, you want to execute on that so we can maximize our opportunities. As we close out, I just want to thank you again, everybody, for joining. On behalf of Kevon Chisholm, who is our founder, I just who could not be here today, but sent his love and support for us, and he wanted me to give a special thank you to you guys who came on today and were able to hopefully gain some more insight on understanding and how to create your own investing goals. Everyone have a wonderful evening and get started today. Don't wait. Get started. If you haven't started, get started today. And if you know a camper and you would like to donate to our cause, I've also put our information in the chat at juniorwallstreeters.org for our summer camps that are coming up, and so that they can be alumni and we can continue to grow and share the wealth with them as they are aging and maturing into adults. Have a wonderful day, everybody.